Hi, my name is Fan Yang, your Chief Technical Strategist here at ForexMinute.com. You're watching today's Forex video briefing. It is Thursday, July 17, and we're in the middle of the US session. Today was relatively quiet as the Forex market consolidated recent US dollar strength. Let's take a look at the Aussie dollar, Kiwi dollar, and gold charts for some technical setups for the rest of the week and the upcoming one. In the 4-hour Aussie dollar chart, you can see that the market has formed a head and shoulders pattern. The main thing is to note that there was this exhaustion push to 0.95, which was rejected, and now price is respecting the common highs around 0.9440, shown by last week's clear out action here, which basically suggests a bearish outlook after that failed bullish attempt. As price starts to trade below the moving average now, in this 4-hour chart, the moving averages of 200, 150 periods. Now, as it trades below that, the pressure is on this neckline, and the bearish outlook grows, especially if that neckline breaks at 0.9320. Although this might not reverse the bullish outlook and the uptrend in 2014, which started in late January, there would be some short-term bearish bias towards the 0.92 to 0.9220 area. Let me go to the daily chart. So the 0.92, 9210 area, which was support in June and May, as well as in April. The Kiwi dollar has been very bullish in 2014, but has been falling in July after a new high on the year at 0.8835. The current slide is attributed by many to a slide in dairy prices. We did see a similar dip in dairy prices in April, and the Kiwi dollar US dollar pair followed that with a consolidation, but eventually continued the uptrend. So we can have a similar anticipation of bearish correction consolidation period ahead for the rest of July and maybe August, but when price nears the 0.86 level, we should consider looking for support from the rising 2014 trend line. A break below this trend line could put the focus on the 0.85 to 8520 support area from April and May. And this can shift the bullish market into a sideways one for the rest of the year if it breaks below 0.86. Gold prices slid about 4% since the 1345 high last week, down to a 1292.20 low this week. The slide engulfed the previous consolidation area, which suggests that the previous bullish breakout was exhaustion. This in turn signals a bearish outlook. We are getting a pullback today, but if price approaches 1325.30 area, look for resistance, especially if the RSI is back around 60, which is where it is right now. So we are getting there. Price is a little sharper than I would like to see in a pullback to fade from. So be careful. We should look for the price to stall first, and if it does stall here, while the RSI also stalls around 60, then we can look for a bearish attempt back towards these lows here at around 1292.20, and if these lows break, there is further downside risk towards the 1270 area, which, as you can see in the daily chart, is a support resistance area. And a dip towards area would still be within this consolidation mode in 2014. So it's not really a bearish outlook. It is a bearish outlook in the short term, but in the medium term, it's within the context of a sideways market. Okay. However, if price breaks above, go back to 4-hour chart. If price breaks above 1335, for example, the short-term bearish outlook should be shelved, and the market could be shifting back to a neutral / bullish outlook instead of this neutral / bearish outlook. And that wraps it up for today's Forex video briefing. Once again, I'm Fan Yang, your Chief Technical Strategist here at ForexMinute.com, wishing you good, safe trading.